Credit scores are not mysterious. They are actually pretty simple once you understand the few things that actually matter. But most people have no idea how theirs is calculated, and that is costing them real money every single month. Let me break it down in plain English. Welcome to the Money Mind. Today we are explaining credit scores. No confusing jargon, no unnecessary complexity. Just the stuff you actually need to know to understand your score and start improving it right away. Whether you are building credit for the first time or trying to bounce back from a rough patch, this video is for you. Let us get into it. First, what even is a credit score? Think of it like a financial report card. It is a 3-digit number, usually between 300 and 850, that tells lenders how risky it is to lend you money. The higher your score, the more trustworthy you look on paper. A score above 740 is generally considered excellent. Between 670 and 739 is good. Between 580 and 669 is fair. And below 580 is considered poor. Now here is why this matters in real life. Your score affects everything from whether you get approved for a credit card or a mortgage to what interest rate you actually pay. Someone with a 760 score might get a mortgage rate around 6%, while someone with a 620 score could end up paying closer to 8% on the exact same house. Over a 30-year mortgage, that 2% difference can cost you over $60,000 in extra interest. Same house, same neighborhood, just a different credit score. Now here's the part most people get wrong. What actually makes up your score? There are 5 factors, and they are not weighted equally. The biggest one is payment history. It makes up about 35% of your score. This one is straightforward. Do you pay your bills on time? Every single month? Because every missed or late payment hurts. One payment that is 30 days late can drop your score by 50 to 100 points overnight. That is not a typo. One late payment. The good news is that the impact fades over time. A late payment from 3 years ago matters way less than one from last month. And consistently paying on time is the single most powerful thing you can do for your credit. Set up auto pay if you have to. Whatever it takes to never miss a due date. The second biggest factor is credit utilization. That is about 30% of your score. This one confuses a lot of people, so let me make it simple. Utilization measures how much of your available credit you are actually using at any given time. If you have a credit card with a $10,000 limit and you are carrying a $3,000 balance, your utilization is 30%. Lenders generally want to see this below 30%, and below 10% is even better. Think of it this way. A lender sees high utilization and thinks this person might be financially stretched. Low utilization says this person has access to credit but does not rely on it. Here's a trick most people do not know. Utilization resets every single month. So even if you had high utilization last month, paying it down before your statement closes this month immediately helps your score. It has no long-term memory for this factor. That is actually great news. The remaining 3 factors are smaller but still worth knowing. Length of credit history is about 15% of your score. The longer your accounts have been open, the better you look. This is why financial experts always say do not close your oldest credit card, even if you are not using it much. When you close it, you lose that history and your average account age drops. Credit mix makes up 10%. Lenders like seeing that you can handle different types of credit. A credit card here, maybe a car loan there, perhaps a student loan. You definitely should not go take out loans just to improve this factor, but if you naturally have a mix, it helps. And new credit inquiries round out the last 10%. Every time you apply for new credit, the lender does a hard pull on your report. That can temporarily lower your score by a few points. One inquiry is no big deal, but applying for 5 credit cards in 1 month sends a signal that you might be desperate for credit, and that is a red flag. So how do you actually check your score and make sure everything is accurate? You can get a free credit report from each of the three major bureaus, Equifax, Experian, and TransUnion, once a year at annualcreditreport.com. That is the official site, not the ones you see advertised on TV. Many banks and credit card companies also show you your score for free right in their app now. I would recommend checking it at least once every few months so there are no surprises. And here's something important. If you spot an error on your report, like a payment marked late that you actually paid on time, or an account you do not recognize, dispute it immediately. Errors on credit reports are way more common than you would think. Some studies have found that 1 in 5 reports has a significant error. Fixing them can give your score an immediate and sometimes dramatic boost. Here's the bottom line. Your credit score comes down to 5 things. Pay on time, keep your balances low relative to your limits, do not close old accounts without a good reason, have a healthy mix of credit types, and be strategic about when you apply for new credit. That is it. No secrets, no tricks, no expensive credit repair services needed. Just consistency and a little bit of knowledge. If you found this helpful, hit subscribe and check out our other videos on building credit and managing money smarter. I am the Money Mind. Let us keep building.